The video everyone is watching right now is wrong. Not wrong about Japan. Wrong about what's actually breaking. Because Japan isn't the bomb. Japan is just the trigger. The bomb has been sitting under the global economy for 17 years. It's been quietly funding the tech boom in your 401k. It's been quietly inflating the housing market you can't afford. It's been quietly making a handful of hedge funds richer than entire countries. And almost nobody on YouTube has explained it to you. Not really. Not the way it actually works. So if you've been hearing about Japan and the yen and walked away thinking, okay, but I still don't really get it, you're not stupid. Almost nobody explains this trade properly, because the second you understand it, you start to see how rigged the entire game has been. By the end of the next 15 minutes, you will understand it completely. The trade, the players, the damage, and what happens to your money when this thing finally breaks. It's not Japan you should be watching. It's the yen carry trade. Picture this. A giant golden pipeline running across the Pacific Ocean, from Tokyo on one side to Wall Street on the other. Inside, instead of oil, rivers of yen becoming dollars. On top of the pipeline, executives in suits popping champagne. Underneath, in the shadows, people like you looking up. Hold that image in your head. We're coming back to it. And before we go further, if you want more breakdowns like this, hit subscribe. It tells the algorithm to keep showing you the truth instead of the noise. Let's get into it. So what is the yen carry trade? Forget every textbook definition you've ever heard. Here's how it actually works. Imagine a friend hands you a credit card. No limit, 0% interest, forever. You take that card. You pull out $100,000 in cash. You walk across the street to a bank in another country, and you deposit all of it into a savings account paying 5%. Every single year you make $5,000, doing nothing, sitting on your couch. That's the trade. That's the whole thing. Now scale it up. Don't imagine $100,000. Imagine 4 trillion. The biggest hedge funds on Wall Street, the biggest banks in Tokyo, the biggest pension funds on Earth, all running this exact play on a scale so massive the numbers stop feeling real. The credit card is the Japanese yen, borrowed at near 0%. The savings account is everything else: U.S. Treasury bonds, Apple stock, Nvidia stock, Tesla stock, crypto, real estate. Anything that pays more than zero, which, for 17 years, was almost everything. Let me give you a sense of how big $4 trillion actually is. $4 trillion is bigger than the entire economy of Germany, bigger than the entire economy of Japan itself. Stack it next to the United Kingdom, France, and Italy combined, the carry trade is still bigger. If the yen carry trade were a country, it would be the third largest economy on Earth. Bigger than every country except the United States and China. A country with no flag, no borders, no president, no accountability, just a flow of borrowed money so massive it warps every market it touches. This wasn't a niche trade. This was the strategy. The infinite money glitch that funded the 2010s tech boom, the meme stock mania, the crypto explosion, the housing market that priced you out of your own neighborhood. So, who's actually doing this? Who's pulling the strings on a $4 trillion trade that almost nobody talks about? Let me name them. Because you deserve to know. Start at the top. The biggest hedge funds on the planet. Citadel, Millennium, Bridgewater, Point72. Names attached to men whose net worths are larger than the GDP of small nations. They borrow yen by the billions, convert it to dollars in seconds, and pour it into whatever asset is rallying that quarter. Then the Japanese megabanks. Norinchukin, Japan Post Bank, Mitsubishi UFJ. These institutions have been recycling Japanese household savings into U.S. treasuries and global bonds for decades. In 2024, Norinchukin alone took a loss so brutal on its U.S. bond portfolio that it had to announce it was selling $63 billion of foreign bonds just to survive. $63 billion. From one bank. And almost no American news outlet covered it. Then, the pension funds. The Government Pension Investment Fund of Japan, the GPIF, manages over $1.7 trillion, the single largest pension fund on Earth. Over half of its foreign bond portfolio is parked in U.S. treasuries. Your retirement somehow is connected to a fund managed in Tokyo by people you'll never meet, making decisions you'll never see. The whole pyramid runs on the same fuel. Cheap Japanese money chasing higher returns somewhere else. Now here's the part nobody on TV will say out loud. When Apple stock went up 30% last year, when Nvidia tripled, when Tesla ripped, that wasn't just innovation. That wasn't just earnings. A massive chunk of that was borrowed yen. Hedge funds, leveraged 10 to 1, 20 to 1, in some cases 30 to 1, riding a wave of free Japanese money straight into your favorite tech stocks and pumping the price. And while the price went up, who got rich? Not the worker who couldn't afford a house. Not the family that gave up on having a second kid because daycare costs more than rent. Not the 28-year-old who watched the S&P 500 hit record after record and still felt poorer every year. The people who got rich are the same people who always get rich. The ones who could borrow billions at 0% while you were getting denied for a car loan at 9%. The ones who could leverage 30 to 1 while your credit card charges you 24% for being 5 days late. This is the part the comments under every macro video keep screaming about. The rich getting richer. The poor getting poorer. It's not a vibe. It's a mechanism. And the mechanism has a name. The yen carry trade. It was engineered. It was rigged. And it has been running in plain sight for 17 years. Remember the pipeline? The one I asked you to picture at the start? It's not a metaphor. It's a map. Every dollar of borrowed yen that pumped Apple, Nvidia, Tesla flowed through that pipe, and every champagne bottle popped on top of it was paid for by people who never saw the pipe at all. If this is landing for you, drop a comment below telling me what part finally clicked. And smash that like button. It's the only thing that tells YouTube to push this video to the people who actually need to hear it. Now let's get to the part where it all starts to break. August 5th, 2024, a Monday. If you owned stocks that day, you remember the feeling. You opened your brokerage app and the screen was red. Not a normal red, a horror movie red. The Nikkei, Japan's main stock index, fell over 12% in a single session, the biggest single-day drop since 1987. The S&P 500 dropped 3%. The Nasdaq got cut harder. Bitcoin, in 48 hours, fell from $65,000 to $49,000. $16,000 per coin, vaporized. Let me tell you about John. John is 43 years old. He's an electrician in Phoenix, Arizona. 2 kids, a mortgage, a 401k he checks maybe once a month because checking it more often makes him anxious. On Sunday night, August 4th, John went to bed. His retirement account had $218,000 in it. Money he'd saved over 15 years of pulling wire through attics in 110-degree heat. On Tuesday morning, August 6th, he opened the app. The number said $204,000, $14,000. Gone. In 2 days. John doesn't read the Financial Times. He doesn't follow the Bank of Japan. He's never heard the words yen carry trade in his life. But on that Monday in a building in Tokyo, 3 men in suits made a decision. And John paid for it before he even finished his morning coffee. That's the trade. That's how it touches you, even when you don't know it exists. Most of the financial press blamed it on jobs data. A weak U.S. payrolls report, recession fears, the usual macro vocabulary nobody really understands. That's not what happened. What happened was the carry trade hiccuped. The Bank of Japan had just done something it hadn't done in 17 years. It raised interest rates, not by a lot. Just 0.25%, but to a market built on the assumption that Japanese rates would stay at 0 forever, it was an earthquake. Here's the chain reaction. Watch closely, because this is the exact same chain reaction that's about to happen again, only bigger. Step 1. Bank of Japan hikes rates. Suddenly, borrowing yen costs more. Step 2. The yen strengthens against the dollar. Hard, fast, 400 pips in a few hours, moves that historically took months. Step 3. Every hedge fund that borrowed cheap yen and converted it to dollars now has a problem. The dollars they bought are worth fewer yen than the yen they owe. Their loan just got bigger overnight, just from currency math. Step 4. Margin calls. The brokers and banks that lent the yen call up the hedge funds and say, "Post more collateral or we close your position." Step 5. The hedge funds don't have more collateral, so they sell. They sell the most liquid, most profitable thing they own, which is U.S. tech stocks, Apple, Nvidia, Microsoft, Meta. They dump them in size into a market that wasn't expecting it. Step 6. Stocks crash. Crypto crashes. Everything correlated to the trade unwinds in a chain. 48 hours. That's all it took. From a quarter-point hike in a country most Americans don't think about, to John's 401k bleeding $14,000 before he'd finished his morning coffee. That was the warning. That was the trailer for the movie. And you didn't hear about it. Not really. Within a week, the Bank of Japan got scared, walked back its hawkish tone, and the markets recovered. The story got buried. Wall Street quietly went back to running the trade. But here's what almost nobody is saying out loud. In 2024, the trade was contained. In 2026, it won't be. The structure of this trade has fundamentally changed in 2026 in a way it had not changed in 2024. And the people running the trade know it. Look at what they're actually doing, not what they're saying on television. Here's what's different. April 28, 2026. The Bank of Japan held a policy meeting. Ueda kept rates unchanged. But the vote was 6-3. 3 board members wanted to hike right now. That is the most divided vote since Ueda took over the central bank. The hawks are no longer a fringe, they're nearly half the room. Earlier this year, in January, Japan's 40-year government bond yield punched above 4% for the first time since the bond was created in 2007. The 30-year had its biggest single-day yield spike since 1999. This isn't a market drifting higher. This is a market revolting. At the same time, Japan's new Prime Minister, Sanae Takaichi, is pushing aggressive fiscal expansion, tax cuts, and spending into a country whose debt-to-GDP ratio is already 236%, almost 2.5 times worse than the United States. And bond markets are pricing that recklessness in real time. Meanwhile, the Federal Reserve isn't cutting fast enough to offset the squeeze. The interest rate gap that made the carry trade free money for 17 years is shrinking. Every month, every meeting. And the hedge funds that loaded up at 30-to-1 leverage are now watching the yen strengthen and U.S. equities wobble at the same time. Underwater on both legs, bleeding from both sides. In 2024, the Bank of Japan flinched. They walked it back. The carry trade survived. In 2026, there is no flinch coming. Inflation is sticky. The hawks are voting. The yields have broken out. The Prime Minister is spending. The path is one direction, up. The bill, after 17 years, is finally arriving. So let's get personal. Let's stop talking about Tokyo and start talking about your wallet. 3 things, in this order. First, your 401k is going to bleed. Pull up your retirement account right now. Look at the top holdings: Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla, the Magnificent 7. Together, those 7 stocks make up around 30% of the entire S&P 500. Those are the most carry trade-funded stocks on Earth. They are the favorite destination for borrowed yen. When hedge funds need to dump positions to cover yen margin calls, they don't sell some random small cap. They sell what's liquid. They sell what's up. They sell the Magnificent 7. Translation? If you have an S&P 500 fund, a target date fund, a Roth IRA, you are exposed. Your retirement, the thing you've been quietly building for 15 years, is one Tokyo policy meeting away from a very bad week. Second, your mortgage is going to get more expensive. When Japan starts repatriating capital, when those pension funds and megabanks finally decide owning Japanese bonds at 4% is better than owning U.S. treasuries, they sell. Japan has been the second largest foreign holder of U.S. debt for years, $1.2 trillion. When that buyer steps back, somebody has to step in, and that somebody is going to demand a higher interest rate to do it. Higher treasury yields don't stay in the bond market. They spread. Translation: your mortgage rate goes up. Your car loan rate goes up. Your credit card rate goes up. The rate on every single thing you finance goes up. If you've been waiting for mortgage rates to drop so you can finally buy a house, this is what's standing in the way, not just the Fed. Tokyo. Third, everything you buy is going to cost more. When the dollar-yen exchange rate moves violently, it cascades into oil, into copper, into chips, into wheat, into everything America imports. Translation, the price tag at Costco goes up, the price at the gas pump goes up, the laptop you're watching this video on would cost more if you bought it next year. This is why the comments under every macro video are filled with the same exhausted line. We can't afford to live anymore. It's not a feeling. It's a math problem, and the math has been rigged by a trade designed to enrich the people running it, not the people living under it. Here's what I want you to take away from this video. Not panic, not fear, just clarity. For 17 years, the global economy ran on borrowed yen. Hedge funds got rich, mega banks got rich, pension fund managers collected bonuses, stock indexes hit record highs. And at every step, the people who held the credit card were not you. Now the credit card is being pulled, the interest is climbing, the bill is being printed. The only question left is who pays it. And history has a really clear answer to that question. It is never the people who borrowed the money. It is always the people who were never invited to the table in the first place. Remember that pipeline I asked you to picture at the start? The golden one running across the Pacific? The executives popping champagne on top, the people in the shadows underneath? It's still flowing, for now. But the pressure is rising. The valves are creaking. And when it finally bursts, the executives on top will already be gone. Parachuted out, bonuses cashed. The people underneath will be the ones picking up the pieces. They always are. Watch Japan. Watch the yen. Watch the carry trade. Because that's where the next chapter is being written. And your name is already in the footnotes, whether you signed up for it or not. If this gave you a clearer picture of what's actually happening, do two things for me before you leave. 1, drop a comment with your biggest takeaway. I read them, and the comments shape the next video. 2, hit that like button. It's the single most important thing you can do to help this video reach the next person who's still confused, still looking for someone to explain it without the noise. And if you want to go even deeper, if you want to understand exactly why what's happening to the US dollar might be the next domino to fall after the yen, there's a video on screen right now that goes straight into that. Click it. It picks up exactly where this one ends. I'll see you there.